You are standing inside a bakery in Berlin. On the price board behind the counter, one loaf of bread costs 200 billion marks, not 200 marks, not 200,000. 200 billion. The woman in front of you is not carrying a purse or a wallet. She is pushing a wheelbarrow, not to carry groceries, but to carry enough cash to buy a few basic items. By the time you are next in line, the baker picks up a piece of chalk, crosses out the old number, and writes a new one, 250 billion marks. In the 12 minutes you spent waiting, the currency lost another 30% of its value. History has repeated this pattern many times. In Venezuela in 2018, a carton of eggs could cost millions of bolivars. In Zimbabwe in 2008, a bus ticket could require a $100 trillion note. In Lebanon, the currency lost roughly 98% of its value in just a few years, turning doctors and middle-class professionals into the near-poor almost overnight. Many widely cited historical estimates suggest the average lifespan of a fiat currency is around 27 years. The modern US dollar system, untethered from gold, dates from 1971. So the real question becomes this. I have gone back through a century of monetary collapses, from Weimar Germany to Venezuela, Lebanon, and Zimbabwe, to identify what actually survived. Not theory. Not speculation. Historical evidence. By the end of this video, you will know the 5 categories of assets that repeatedly survived monetary collapse, and which assets were destroyed even faster than the currency itself. But before we get there, you need to understand one thing. Stage 1. The government spends more than it takes in. Stage 4. People start looking for alternatives. Gold, foreign currency, hard assets, anything that cannot be printed at will. Stage 5. Confidence breaks completely. The money still exists on paper, but in daily life it stops functioning as money. Weimar Germany moved from roughly 320 marks per dollar in mid-1922 to 4.2 trillion marks per dollar by November 1923. Venezuela's bolivar collapsed from manageable levels to well over $1 million per dollar over time. Lebanon's pound fell from 1,500 per dollar to tens of thousands, then much higher. So when it happens, which assets stand firm, and which ones vanish first? The first survivor is the most obvious, but also the one many people treat as a relic instead of a serious monetary hedge: gold and silver. This was brutally clear in Weimar Germany. If you held paper marks, you were effectively wiped out. But if you held gold, you preserved purchasing power. An ounce of gold could still buy a comparable basket of goods before, during, and after the collapse. The currency changed. Gold did not. The same pattern appeared in Zimbabwe. When the government issued notes with absurd denominations, anyone holding gold had a far better store of value than anyone holding the local currency. And this pattern is not confined to old history. It is happening in real time in places like Turkey. By late 2024, data showed a sharp increase in gold deposits at Turkish banks. In a very short period, the total value of gold-linked accounts surged. Into 2025, the trend continued as citizens increased gold holdings amid persistent inflation, rising living costs, and a weakening lira. When inflation accelerates and purchasing power erodes, people move toward assets with one simple advantage: they are difficult to debase. This is what many gold critics miss. Gold does not need to generate income. It does not need to pay dividends. Its function is not growth. Its function is resistance to currency destruction. When fiat money is created aggressively, each unit loses purchasing power over time. Gold supply cannot be expanded at will, and that scarcity is exactly what makes it attractive during monetary stress. Even in modern crises, the pattern is visible. During the 2008 financial crisis, gold initially fell during the liquidity panic, but after the immediate shock passed, it rose sharply in the following years. In the inflationary 1970s, gold also experienced painful drawdowns before surging again once the monetary damage became more visible. The lesson is simple. Precious metals are not short-term speculation tools. They are stores of value when the monetary system malfunctions. When a domestic currency begins to fail, one of the most common escape routes is a stronger foreign currency. Imagine a person who had saved the equivalent of $50,000 over many years. For decades, the Lebanese pound was pegged to the US dollar at roughly 1,500 to 1. That peg created an illusion of stability. Then it broke. As the exchange rate collapsed, savings denominated in local currency were destroyed in real terms. What had once represented $50,000 in value could eventually buy only a tiny fraction of that amount. The number in the account may not have looked shocking at first, but the purchasing power vanished, and the principle is not limited to the dollar. In another context, it could be the Swiss franc or the euro. The point is not the specific currency. The point is holding a currency that is not collapsing when yours is. Zimbabwe effectively dollarized before the government formally accepted it. Ecuador moved to the US dollar after crisis. El Salvador followed. Panama had long used the dollar as a functional monetary anchor. In Venezuela, large transactions increasingly shifted into dollars. In Argentina, real estate has often been priced in dollars rather than pesos. Cambodia also shows this logic in practice. When the local currency loses function, people spontaneously migrate towards something more stable. Governments can issue decrees, but in the end, the public decides what money actually works by choosing what to hold and what to spend. When crisis becomes severe, governments often begin closing the exits. They impose withdrawal restrictions, capital controls, exchange controls, and transfer limits. Sometimes they freeze parts of the banking system itself. That means the time to prepare is before the doors start closing, not after, because stocks are not just ticker symbols. They represent ownership in real businesses, real assets, real production, and in some cases, real foreign currency cash flow. If a company owns factories, machinery, inventory, land, or other real assets, those assets do not disappear just because the currency collapses. Their price in the collapsing currency rises. So the stock price may explode upward in nominal terms, not because the country is healthy, but because the currency unit used to measure value is disintegrating. A company that earns only in collapsing local currency may see its real economics deteriorate badly, even if its stock price rises in nominal terms. Why? Because it still needs to import equipment, materials, or inputs that are priced in harder currencies. By contrast, a company with real productive capacity and foreign currency revenue, especially exporters, can actually benefit relative to purely domestic firms. If a meaningful share of revenue comes in dollars or other strong currencies while local costs are still paid in weaker domestic money, margins can improve during devaluation. Research on Latin American crises, the Mexican peso crisis, and the Asian financial crisis repeatedly points to the same conclusion. Direct ownership of productive enterprises with export capacity often survives and sometimes thrives, while many other assets are crushed. After World War II, parts of Germany saw this clearly. The official currency had become so weak in daily life that barter took over. Cigarettes, coal, potatoes, and other goods became functional exchange tools. Cigarettes in particular worked surprisingly well as money because they were standardized, divisible, portable, and widely accepted. In many settings, they behaved like an unofficial currency. This was not metaphor. It was how exchange actually functioned, and the same kind of thing reappeared elsewhere. In Venezuela, as the bolivar lost credibility, direct exchange became increasingly important in certain contexts. Fish for flour, goods for services, immediate use items for survival. In these environments, what holds value is often not money in the formal sense, but things people need right now: food, medicine, water, fuel, batteries, soap, sanitary goods, and basic tools. These are tactical assets, not strategic long-term stores of value. They are meant to be consumed. You cannot build an entire wealth preservation strategy around painkillers or spare batteries, so the correct use of this category is limited. It is useful for short-term disruption and acute crisis phases, not as a primary long-term store of wealth. In the Great Depression, farming families with productive land had a much clearer path to survival than many urban households. They could grow food, preserve it, raise livestock, and maintain a degree of independence that city residents often lacked. But farmland is not a perfect hedge. Second, it is politically exposed. If the political environment deteriorates and property rights become fragile, farmland can become a target. Zimbabwe is the classic warning. Beginning around 2000, state land seizures destroyed commercial agriculture, wiped out property rights, and devastated production. Agricultural output collapsed, and the value of many farms was destroyed almost overnight. Third, farmland tied to export crops is usually much stronger than farmland dependent only on domestic collapsing currency. If the land produces goods that can be sold into hard currency markets, it is a much stronger hedge than land trapped entirely inside a failing domestic monetary system. Government bonds, treasury bills, local currency debt instruments, these are often among the worst places to be during monetary collapse, because they are simply claims on future payments in the very currency that is being destroyed. Weimar Germany is the classic example. Bondholders were wiped out because the marks they received back had almost no real value left. Argentina provided another version of the same story during its sovereign crisis. In these situations, Nominal repayment means very little when the money itself has been hollowed out. Fixed income sounds safe only when the unit of repayment remains stable. When the unit itself fails, safe becomes meaningless. Local currency deposits lost most of their real value as the pound collapsed. The number displayed on the account statement did not initially tell the full story, but purchasing power was being destroyed. Iraq has shown signs of severe cash stress, withdrawal pressure, currency weakness, and collapsing public trust in parts of the system. Turkey has shown rising gold accumulation behavior that often accompanies inflationary concern. Lebanon has already moved deep into late-stage monetary breakdown. The US is not Weimar Germany or Lebanon, but large debt burdens, rising interest costs, and the long-run erosion of unquestioned reserve dominance are all real issues worth watching. History has seen dominant reserve currencies lose their place before. Britain once held that position too. The point is not to predict an exact date. It is to recognize that no fiat system should be assumed permanent. Currency collapse is not a fringe theory. It is a recurring pattern. Most fiat currencies eventually disappear, are replaced, or lose much of their real function. What matters is not trying to guess the precise day. What matters is understanding how individuals and systems adapt when the cycle turns. Second, strong foreign currencies that can preserve purchasing power when the domestic unit fails. Third, ownership in productive businesses with real assets and ideally foreign currency earnings. Second, savings held in the collapsing domestic currency within a failing banking system. The lesson is not to abandon everything domestic. It is not to become a doomsday prepper hiding gold underground. A truly diversified portfolio includes different forms of value that respond differently under stress. Precious metals as monetary insurance, foreign currency assets as an escape valve, productive international businesses, and in some cases hard assets in stronger legal jurisdictions. The warning signs visible in places like Iraq, Turkey, and Lebanon show that monetary crisis is not ancient history. It is still a live possibility in the modern world. It is making sure no single monetary failure can wipe out your purchasing power. If this financial forensic analysis gave you a new perspective on monetary risk, consider following the channel. And as always, this is not financial advice. It is educational content, and your outcome will depend on your own judgment, preparation, and decisions.